The top business stories live from the Sky News City studio. Thames Water secures an additional £750 million from shareholders, less than it was looking for. BT confirms it's seeking a new chief executive after the incumbent Philip Johnson said he intends to step down. And new research suggests that details of more than a third of all global mergers and acquisitions leak. Good morning, this is Business Live with Ian King. Thames Water has this morning announced that its shareholders will inject a further £750 million worth of equity into the business during the next 2 years. Well, the cash injection comes on top of the £500 million that investors put into the company in March. Thames said a further £2.5 billion would need to be raised between 2025 and the end of the decade. Well, the news came as Thames reported an underlying pre-tax loss of £82.6 million for the year to the end of March. That was down from a loss of £935.6 million during the previous 12 months. The company also revealed that its debt pile grew from £12.9 billion to £13.9 billion during the period. Well, Thames Water couldn't bring themselves to speak to us today, but joining me now is Alan Smith. He's an industry consultant who's previously worked for Severn Trent Water, South West Water and Yorkshire Water. Alan, welcome to you. Clearly, Thames has been able to raise some equity, but we heard from Ofwat last week they were looking for £1 billion. They haven't raised that.
No, it's a bugger's muddle, Ian, to be honest with you. They not only Thames, but the industry is in a mess. I think it's complacency, it's a combination of greed, arrogance, particularly at the board level. By the way, not for the 50,000 guys that run and manage brilliantly well the treatment work, etc., but the way that the industry is managed, the way that the industry is regulated, is just not fit for purpose. It's a broken model and things need to change. And they don't need to have elastoplast and sticky tape, which is what we've heard this morning. We need something that's sustainable for the future. And the only way to go is to get the new model in and get rid of this lot.
And what would that entail? Would that mean nationalisation?
No, not at all, no. I've been there, Ian. I spent half of my career in the public sector, and when privatisation came in '89, it was brilliant. It was exciting. There was a huge injection of cash and investment that was not there before. Progressively, over the period, though, 10 years or so, the industry became complacent. Ofwat became massively inconsistent and is now totally inappropriate, in my view. And so the whole thing is slipped down to short-termism, expediency, and really not fit for purpose, not for long-term investment, which is what the industry is all about.
Well, that's a very good point. I mean, how does one get new investment into this sector when it's been so egregiously managed?
Well, let me tell you what we should do. And I've said this in a release I did yesterday. DEFRA should get round the table with the Treasury, with Ofwat, and devise and look at the way that we can give compensation to the current shareholders of the current broken model. We should then introduce a highly successful model, which Welsh Water have now been in operation with since 2000, over 20 years. It's proved very successful. It's not for profit. It makes surpluses. Those surpluses go back into capital investment, with treatment works, etc. And the customer, and this is really important, Joe Public thinks that it's a great move, and they've got much closer to their customers than they did do in the years before.
You mentioned just now, Alan, that you thought that Ofwat was unfit for purpose. It's quite interesting to know that Thames's new co-chief executive is a former Director General of Ofwat. Should that sort of thing be allowed?
No, it shouldn't. And don't tell me they're not liaising with one another on a fairly regular basis. So there's no arm's length there. And that complacency leads to the sort of inefficiency that we've got. I mean, bear in mind, Ian, that in the past decade, Ofwat were all about scrambling around to reduce bills. And that, of course, was at the behest of the government and DEFRA. Now they're being told, oh no, we need to invest a lot more now for the sewer overflows, etc., under the pressure. So the inconsistency is phenomenal. And you cannot have inconsistency in a long-term business, in a long-term industry that depends on regular and consistent water supplies and sewage treatment for 60 million customers. Not fit for purpose, time to go.
Now, among the shareholders of Thames Water right now is the university's superannuation scheme, which of course runs the retirement savings of thousands of university lecturers and teachers up and down the country. How worried should they be about their equity stake being potentially wiped out?
I'm not so sure they'll be wiped out, and I'm sure there will be some sort of a compromise. But, let the buyer beware. If you're into an industry that 70% of which is owned overseas, you have to expect that there might be issues and there might be risk. And that's something that they've got to look at. But my view is, if I was in their position and I was their chairman, I'd be looking for a new investment as quickly as I could.
Yeah, I mean, this is the interesting thing, isn't it? They wanted $1 billion. They've only raised 750 million. I mean, clearly there's a tolerance to what shareholders are going to accept and perhaps maybe reluctance to throw good money after bad.
Well, of course it is. And of course, the reason they're in the pickle that they're in is that they initially didn't borrow enough or equity enough. And 70%, as you know, is debt, which is index linked, which puts them in the position that they're in today. So it's been very, very poorly managed, very, very poorly regulated, and I've got to say, by an interfering government that really doesn't know which way to turn.
That's an interesting point. Why do you say that?
But DEFRA is not fit for purpose. I mean, it's a weak organisation. Look at where they are now. I don't want to name names, but I mean, look at the head, Teresa Coffey. I mean, come on. I mean, she's been in the job about 60 days, I think. She doesn't know the water industry. We're lacking now at that level, especially within the DEFRA corridors, of people who actually understand and know the industry. So they move from crisis to crisis. I mean, for example, the plan for water shambles in April was a regurgitation of many things that they've been looking at before. And to be honest with you, the select committees, so they know what that the blame can be shared around here. You look at the select committees from Parliament, they're just not fit for purpose either. I mean, you get the likes of Sir Robert Goodwill saying at the weekend about Ofwat, oh, have they been asleep at the wheel? Have they been very complacent? In my view, they have. Has Southern Water's credit rating and the way it's gone down? It does seem rather reckless. Come on. I mean, that's like being hit with a dead fish. I mean, something needs to happen. And in the palaces of Westminster, that sleepy lot needs to get together and to look for, and certainly look at the Welsh water model, which has been highly successful. It's not for profit. It delivers, and the customers are delighted. So time for change, Ian, and can't come soon enough.
Alan, it's been suggested that the publicly quoted water companies, the likes of Pennon Group, which owns South West Water, Severn Trent, they've been rather less badly run over the years than the likes of Thames Water, which of course are privately held and sit behind these very opaque financing structures. Is there a case for saying that all of the water companies should be at least partially listed on the stock market in the name of transparency?
Well, I think with any large infrastructure industry as this is, there are going to be good players, there are going to be bad players. But let me just take a step back from that, Ian. What does Joe Public want? A guy who turns the tap on and flushes the loo. Does he want profit to be made out of a monopoly company on an essential service, an essential for life service? The answer is, and he's told us since 1989, 79% of the public did not want profits, dividends, and shareholders in a company that provided such an essential service. Today, after £200 billion of investment, and I was involved in a lot of that, it's 83%. So the public do not want it. So scratching around with those that, I think that's tinkering around with the model that's broken, looking at what might be less unfavourable than another is not the way forward. I think in a water industry, and as I say, I've been in it for 50 plus years, and I've worked in the public sector and the private sector, so I've seen the good and the bad of both. But my view is that the compromise between those two is the not-for-profit. And Welsh Water have done the testing, and it's been highly successful.
OK, Alan, got to leave it there. Appreciate you joining me today. Thank you.
OK, take care, Ian.
Some other business news stories for you now. And BT confirmed this morning that it's begun the search for its new chief executive, confirming a story broken by Sky's Mark Glyman at the weekend. BT said the current CEO, Philip Jansen, had indicated he planned to step down at some point during the next year. He's been in the role since February 2019. Well, among those being tipped as his successor are Mark Alera, the head of BT's consumer arm, and Alison Kirkby, a non-executive director of BT, who's currently chief executive of the Scandinavian telecoms group Telia. The Medicines and Healthcare Products Regulatory Agency, the UK's medicines regulator, has approved GSK's vaccine for respiratory syncytial virus, or RSV. The MHRA authorised GSK's shot, which is called Arexvy, to be used to immunise patients against lower respiratory tract disease caused by the virus. Well, RSV causes thousands of hospitalisations and deaths annually. It normally presents as cold-like symptoms, but it's a leading cause of pneumonia in toddlers and the elderly. And the student accommodation provider Unite Group said this morning that reservations for the 2023-24 academic year were at record levels. The company, which has nearly 28,000 beds in 71 properties across 19 university towns and cities, said 98% of rooms were now sold for the year. Unite also said that as at the end of June, its property portfolio was independently valued at £2.92 billion. That was up 1.2% on the position at the end of March. Well, we're just going to briefly step away from the business news at the moment to the breaking news from Tewkesbury. I can show you some of the first pictures that have come in from Tewkesbury School, which has been placed into lockdown after a teenager was arrested after a teacher was stabbed at the secondary school. Gloucestershire police have said that an adult has been taken to hospital with a suspected stab wound. The force said officers were called at around 9:10 on Monday this morning to reports that a pupil had stabbed a teacher and a teenage boy has been arrested. More on that as we get it. Well, equity markets in the Asia-Pacific region saw mixed trade overnight following further declines on Wall Street on Friday afternoon. The Nikkei in Tokyo fell for a fifth consecutive session. Well, in Europe, stocks have started the week on a largely positive note. Here's the current picture. Only the IBEX in Madrid in negative territory right now. Talking points this morning include Julius Baer. The wealth manager is up 1% after its CEO gave a bullish interview with the German newspaper Handelsblatt. That, of course, is a company listed in Zurich. Well, here in London, the FTSE 100 is in positive territory, albeit only by 0.1%, helped by a rally in some of the energy stocks. Flutter Entertainment is the leading percentage gain. There look to be a few bargain hunters coming out of the woodwork after last week's declines to a six-month low. Outside the FTSE, the online trading platform Plus 500 is ahead by some 2% on a trading update, while the publisher Future is ahead by 7% after announcing a share buyback plan worth up to £45 million. The legal services provider Knights Group, meanwhile, we've had the CEO of that company on the programme in the past. They're up 6.5% on a trading update, but the healthcare services provider Totally is down by 25%, and that is on a downbeat trading statement. On the foreign exchange markets, well, the dollar has recovered some of its poise after Friday afternoon sell-offs. Accordingly, sterling is off by just over 1/3% against the greenback. It's also off by 1/4% against the euro. The single currency, meanwhile, off by 1/10% against the dollar. As for the oil price, well, that enjoyed a solid gain last week, but it's begun this week trading to the downside. A barrel of Brent crude will currently set you back $78.07 a barrel. That's a little over 0.5% lower on the session. Well, joining me now is the investment director at AJ Bell, Russ Mould. Russ, good to see you this morning.
Thank you.
So, Philip Jansen's leaving BT. Bit of a surprise, this, or not really?
I think there was no real intimation of it beforehand, but he's coming up to 5 years in office, and that's exactly bang on the average for current FTSE 100 CEOs. So you can maybe say, OK, no great surprise there. And in some ways, he might be quite pleased to get out the back door, because you look at the share price while he's been in charge, it's more or less halved, and at 120p, or there or there, they're back to where they were in December 1984, straight after the Thatcher privatisation. So it's been, in some ways, you have to feel for BT. It's got the regulator breathing fire on one side. It's got lots and lots of competition in broadband, in wireless, in TV, and customers who are very willing and able to switch around. So it's very kind of cabin cribbed and confined on all fronts, effectively, and that's why the share price has done what it's done, despite Mr. Jansen's best efforts with the Discovery Sport merger and all of those things.
Absolutely. I mean, it's fair to say he has done a pretty good job, hasn't he? I mean,
he has.
He's reached a settlement with the regulator that they're building out at Openreach as fast as they possibly
Reinstated the dividend. I think under the circumstances he's done what he could, but I think, I know there's lots of comment on regulators whether they've done a good or a bad job. I think from a consumer's perspective in telecoms right now, the customer is probably getting the better end of it than the shareholder in the company, in BT's case. Now,
this evening we had the Mansion House speech. There's a lot of stuff coming down the pipeline with implications for the investment industry. What do you make of what you've been reading thus far?
I think the thing on digital shares is frankly something that's been in process for a very, very long time. Nobody really wants to run the risk of having a shoebox under the bed and the paper certificates get lost. And most private investors now own their shares through retail investment platforms, so it's a largely digital process anyway. Anybody with a paper certificate, that can be now handled quite easily and digitised. So that's a natural progression of something we've seen. I guess the exciting thing there for private investors might be voting in AGMs directly, maybe one logical consequence of that as the next step. The early stage investment, I think, is clearly going to be very interesting. This 5% pledge that Mr Hunt's looking to nudge the pension funds towards. Although, I guess the tricky bit there is, if we're saying that high-risk investments guarantee you high returns, then they're not really high-risk investments, are they? So I think we need to be a little bit careful there. And also the pooling of funds to create big super funds like we see in Australia or Canada to cut fees out, well, I'm sure that's going to be seen as a good thing for those people whose money are in those funds.
Yeah, Russ, always good to see you. Thanks for joining me today. Still to come here on Business Live. We're going to be looking into new research which suggests that more than a third of all global mergers and acquisitions are leaked. Don't go away.
Well, they've risen to 17,000, which is an all-time high, and we expect them to keep increasing, so about 26,000 by 2040. And what's behind it is actually really interesting because it relates to social trends. Skin cancer takes a long time to develop. So what we're seeing is actually the effect of UV exposure potentially many decades ago. In the 60s, as you said, there was an increase in package holidays, much lower awareness that UV rays could cause skin cancer and much lower sunscreen usage. So these are all factors, and we have an ageing population, so there's a bulge in the over 55s, which is also contributing to the increase in actual numbers. Definitely what we saw since the 60s is that there was a trend towards being tanned being a positive thing. And so, but also sunscreen usage was much lower then, as you said. So over the years, I think that's changed. Our recommendation very much is for SPF 15 at the very least, and that's when it's applied regularly according to the instructions and generously. Some people recommend SPF 30 as well to take into account the fact that a lot of people don't apply sunscreen as generously and regularly as they should. But there have been really great advances in treatment for skin cancer. So now most skin cancers are just excised, so you don't require chemotherapy or immunotherapy, and often an outpatient appointment as well. We think about 9 in 10 skin cancers are preventable, so they're related to UV exposure. So hopefully, over the very long term, as sunscreen usage has become more prevalent, we would like to see that curve changing. But for now, I think people can be reassured that if they spot any changes in their skin, do go to their GP. And actually, if it does turn out to be skin cancer, it will be very treatable.
Welcome back. Now, one of the criticisms most frequently made of generative AI models like ChatGPT is that some of the content they produce can be inaccurate. Well, that highlights the importance of feeding such models with reliable and trustworthy data and has led to a rise in so-called data intelligence companies. Well, one such business is Elation, whose customers here in the UK include Sainsbury's, Marks & Spencer and Very. Joining me now is Sachin Sanghani, the Chief Executive of elation. Sachin, welcome to you. Thank you for joining me at such an unsociable hour. What are the challenges involved in testing the accuracy of a data set?
Well, first of all, it's getting the right data. The challenge that many of these enterprises have is that their data is strewn across so many different data sets and so many different databases that often what they find is that the data scientists can't even find the data in the first place. And then once they do find this data, what they discover is that they can't understand whether the data set is fit for purpose, how the data was produced, where it came from. And so one might expect that this data is all organized and accessible, but quite contrary to the case, many of these enterprises have a lot of disorganized information.
Is this a case of businesses cutting corners, or is it just that this is an incredibly complex matter to get to grips with?
Far more the latter than the former. You find that many of these organizations have grown up over 20, 30, 40 years in their information technology infrastructure. The consequence of that is that you find so many different versions of information, so many different versions of technology. And with all of these different versions, it's really difficult to navigate all this information. A little bit like looking around the web, but not having Google. You have so many different web pages produced over so much time, but hard to understand what's where or what's trustworthy unless you have a central search engine.
What are the regulations governing data provision?
Well, there are not very many specific around data provisioning. There are some certainly around privacy. The best known one of that is GDPR, which certainly was the godfather to many other regulations around the world, including here in the United States. There are others in industry specifically. In the United States here, we have HIPAA, which stands for Healthcare Information Privacy Act. But there aren't very many that sort of globally on an industry agnostic basis govern the management of data, and certainly not the data for artificial intelligence models as is being contemplated in the EU right now.
And very briefly, you completed a Series E funding round last November. You raised $340 million. How have you been putting that to use?
Well, research and development is, of course, absolutely critical in this market, in this space. There is so much that AI brings to bear in both understanding data and being able to describe it at scale, enabling people to use data better, because often data is inscrutable to so many different people who are trying to use it on a day-to-day basis. And then, of course, finally, data is absolutely critical in feeding the models that other practitioners are trying to use. And so R&D is obviously where we're putting together most of our dollars. Of course, there are efforts to globalize the firm, both in the EU and abroad in APAC, but that's certainly secondary.
All right, Sachin, we have to leave it there. Thanks again for joining me at such an early hour. Do appreciate it.
Great to be here, and thank you for having me.
Now, details of more than a third of all global mergers and acquisitions leak, according to research published today by H Advisors, the global strategic communications advisory group. Well, the report suggests that in deals negotiated in Western Europe and Asia are significantly more likely to leak ahead of their official announcement than those in the United States. It also suggests that some sectors, such as aerospace, transport and retail, are significantly leakier than others. Well, joining me now is Neil Bennett. He's Global Co-Chief Executive of H Advisors. Neil, welcome to you. Chatting to Russ Mould before the break, he said only a third.
Only a third. Well, I have to say, 35% of all these 267 deals around the world worth $2 billion or more that we analysed, that's 35% of them. When you consider that everyone who leaks is leaking price-sensitive information, so therefore they're at very least breaching regulations, and in many cases, in many jurisdictions, the law, that's a lot of leaking.
It is. I mean, there isn't leaking itself is not a crime, though. It's when you trade on that information.
Yes, I think it depends on jurisdiction by jurisdiction, but handling price-sensitive information, at the very least, is a breach of trust. And so that's a lot. Now, as we say in the report, we've cut it lots of different ways. Asia-Pacific is the leakiest region, followed by Western Europe. America's significantly less leaky. Other things that have shown, some things you might expect. Big deals leak a lot more than smaller deals. But the sectors are interesting. So a very high proportion of aerospace deals, which surprised us, even more than deals in the media sector, which are pretty leaky, compared to property, where it seems very few deals leak, and you could say that's because people are rather less interested in them.
Yeah, maybe. Well, I mean, you've worked in and around capital markets for decades. Do you think this problem's got worse over time?
I think I don't think it's got worse, but it shows that despite the best efforts of regulators, it's still a significant issue, and that all companies, when planning a big piece of M&A, need to include it in their, factor it into their negotiations and their preparation.
I mean, the thing that really jumped out at me with big transactions, $25 billion plus, 80% of them leak. I guess that's just a function of the number of advisors involved.
Exactly. I think that is because so many people get involved in a big deal that the sort of risk factor goes up exponentially.
So why do you think the US is less leaky? Is it because they've just got tougher regulation?
I think that might be part of it, and the SEC is a genuinely scary regulator. I think the other thing, we're looking at deals over $2 billion and more. So at the smaller end, a $2 billion deal in some markets, let's say the UK, is quite a big deal. A $2 billion deal in America is a bit humdrum.
Yeah.
Maybe people are just not as interested.
Yeah, that's interesting. Crikey, I mean, we could do with a few more $2 billion plus deals in the UK right now, couldn't
exactly.
we, really?
Yeah, that's...
I mean, do you get the sense, though, that many people are actually trading on this information when it leaks?
Well, clearly share price moves. And when the leaks happen, what we've also shown is there's an enormous surge in Twitter traffic. So the word gets out, prices move. And very often, either one party or the other then has to put out a confirmation statement to cleanse the market. So the risk is that people are trading, but that has to be factored in too.
A real headache for people like you.
Well, as I say, what is the solution to this for people, for companies planning a deal is, to paraphrase Tony Blair, preparation, preparation, preparation. Don't leave it to hope and trust that people will stay quiet, but ensure you have a plan to deal with it.
All right, Neil, got to leave it there. Good to see you this morning. Thank you. That's it from me. I'm back again at 4:30 this afternoon. Do stay with us, though. After this, it's Lee Belletto coming up after the short break. See you later. Cheerio.